Hello children, welcome to today's session of online class of Sri Gokulam Guruvayur. Today we are going to discuss about the new ratio, that is return on investment ratio. So take down the notes which I am going to discuss there in the classroom. So solve the problem along with me so that you get the better understanding of doing the problem. Okay, so let us do the problem together. Children, we are going to discuss today the last type of profitability ratio, that is return on investment, that is ROI, or we can also call it as return on capital employed ratio. Let us first of all have a review of types of ratios first. So far we have covered liquidity ratio, solvency ratio, activity ratio, which is also known as turnover ratio, and profitability ratio. Under profitability ratio, we will discuss today return on investment ratio. The formula to calculate return on investment ratio is net profit before interest, tax and dividend divided by capital employed into 100. The expression in which ROI, that is return on investment, is shown is in percentage. If we go in depth with the formula of return on investment, we have already studied how to calculate net profit before interest, tax and dividend. Do you remember children in which formula we have studied this? Interest coverage ratio. So we know how to calculate now in net profit before interest, tax and dividend. We also know how to calculate capital employed. Do you remember in which formula we have studied this? Proprietary ratio. So almost the formula is the same. Let us have the review on capital employed ratio calculation. We have two approaches under capital employed, that is liability side approach and asset side approach. In liability side approach, the items which we have to consider is shareholders fund. Under shareholders fund, which all are the items? Share capital, reserves and surplus. And in case surplus or balance in statement of profit and loss have debit balance, it is deducted to calculate shareholders fund. Debit balance means it's a loss. And the second item which we have to add here is non-current liability. So two items will come under non-current liabilities, that is long-term borrowing and long-term provisions. So these two items are added together under liability side approach. And if you are going with asset side approach, you have to take into consideration these items, that is non-current assets. And which item are considered in non-current assets? Three items: fixed asset, tangible fixed asset and both that is intangible fixed assets. So the both are considered. Then non-current trade investment. Non-current trade investment is also considered. It is assumed that all non-current investment are trade investment unless specified to be non-current investments. So all the items of trade investment we have to take as non-current investment. Okay. Then long-term loans and advances. Those loans and advances which we have given to the outsiders, that is our asset. Okay. So that will be repaid to us. So long-term loans and advances. So these items comes under non-current asset. And second item is working capital. Which are the working capital? Current asset minus current liability. So under asset approach, you have to consider these items. So you can go with any of the one approach. Now let us do one problem. Here you are asked to calculate return on investment. The information given to you are Net profit after interest and tax is 6 lakhs. 10% debenture rupees 10 lakh. Tax is given as 40%. Capital employed amount is given to you 80 lakhs. As usual, write down the formula first. Return on investment is equal to net profit before interest, tax and dividend divided by capital employed into 100. Here, the working capital to calculate the net profit before tax, interest and dividend, you have to show the working note. You can see here net profit after interest and tax is given. But as per your solution, you want net profit before interest, tax and dividend. So go for a working note. Now let us assume that net profit before tax is 100 and you have given that tax is 40%. Check out over here. Look, we can go for a detailed working note. Net profit before tax is 100. We have assumed that as 100. Tax is 40. So before tax your profit was 100. After paying 40 rupees tax, what is your net profit now after tax? It's 60. Okay. So if net profit before tax as per our assumption is 100 and you got net profit after tax as 60. So if 6 lakh, from where this 6 lakh came? It is given in the question that net profit after interest and tax is 6 lakh. So if net profit after tax is 6 lakh, what will be your net profit before tax? So go for a cross multiplication. So you are in proportionate way how much is your net profit before tax you can find out, and that comes to 10 lakh. So your net profit before tax is 10 lakh. But children, net profit before tax is 10 lakh. What about the amount of interest? Here you can see that debenture, which is a long-term borrowing, from that 10% is the interest rate on debenture. So on 10 lakh, if you calculate 10%, you will get 1 lakh. So adding the net profit before tax plus interest together, you will get amount of 11 lakh. This 11 lakh you will substitute over here, and capital employed is already given to you as 80 lakh into 100. You will get the answer as 13.75% return on investment. Now children, let us move to the next problem. From the following information, calculate return on capital employed. And some items are given to you. Net profit after interest and tax, 1,20,000. Tax is 1,20,000. Net fixed asset is 5 lakh. Long term trade investment is 50,000. Current assets is 2,20,000. Equity share capital is 50,000. 10% preference share capital is 50,000. Reserve and surplus is 1 lakh. Current liabilities 1,70,000 and 12% debentures is 4 lakh. So these are the items given to you. First of all, write down the formula. Return on capital employed is equal to net profit before interest and tax divided by capital employed. Children, we will have to move to the working note for calculation of net profit before interest and tax. If you look into the question, you are given net profit after interest and tax amount is also given. In previous question you are given only the rate. So through a working note you have to show how much, or you have to find out how much is the amount of interest that you have calculated, and you have added the interest on long-term borrowings, and then you added that too, and then you got the amount of net profit before interest and tax in the previous problem. Now let us do the calculation of net profit before interest and tax as a working note. So look, you can see here the first working note is calculation of net profit before interest and tax. So that you have to write as a heading. Next you write down net profit after interest and tax. So that is given to you in the question, 1,20,000. So net profit after interest means what? When you calculated net profit, you have subtracted the net profit amount and you have subtracted the tax. Now you want the profit which is before paying, or before you paid the interest and tax. What was the profit that you want to calculate? For that you go back, that is you have to add back the interest on debentures. How much was the interest on debenture? 4 lakh was the debenture, and on that 12% it is given debenture rate. It is given in the question that debenture is 4 lakh and percentage, that is 12%, is its interest. So 4 lakh into 12%, you will get the interest on debenture, and calculating that amount will be 48,000. And tax amount is also given in the question, 1,20,000. So add back this amount from the interest after net profit after interest and tax. You add the amount of interest of debenture and tax. So the answer whatever you get is your net profit before interest and tax. So 2,88,000, that is the first part of your answer you got. Now for calculating capital employed. So there are two approaches in front of us, that is asset approach and liability approach. Let us look what is the asset approach. You know that an asset approach, there are 3 items which we include, that is net fixed asset. It may be tangible and or intangible. If you look into the question, you are provided with the net fixed asset, so that can be included. Then if the other 2 items are not there, then we can proceed with the working capital, that is current asset minus current liability. So as per the question, your current asset is given in the question as 2,20,000 and current liability is given as 1,70,000. So that can be included there. You can see working capital, current asset minus current liability is shown as 50,000 here, and long-term trade investment. So here long-term trade investment is 50,000. So when you add up all these items, you will get 6 lakh as your capital employed under asset approach. Now under liability approach, you are given equity share capital and preference share capital and reserves and surplus. This all the 3 items together is known as shareholders fund. You can add all these 3 items plus long-term borrowings, that is 12% debenture is your long-term borrowings, which is a that is your non-current liability. So that also have to be added up as per the formula. So after adding all these items, you will get 6 lakhs as your capital employed under liability side approach. So you can use any of the one formula and you will get the answer as 6 lakh. So that 6 lakh you have substituted in the formula, and into 100, after calculation you will get 48% as your return on capital employed.